The Nifty holding above the 17,900 mark.
As we speak, we're down 70 points on the Nifty. The Nifty is now trading below that 17,800 mark.
You know, the market broke through the December 26th low, but briefly, 17,774 was that number. I think the low today has been made at about 17,761.
It's been a volatile trading session in trade today, but it seems that the weekly expiry came to the rescue of the bulls yet again.
Hello and welcome to CNBC-TV18. You're watching Markets Today, the show where we track about 6 hours of the day's trading actions in 5 headlines. I'm Sonal Bhutra. Here are the headlines for the day. Sensex and Nifty end with marginal losses despite a late pullback. Sensex slips below 60,000 while Nifty closes at 17,858. Broader markets underperform the benchmarks with IT stocks supporting the markets. NCLT Mumbai approves the merger of multiplex chain Inox and PVR. Sources say that a written order is likely in next 15-20 days. That's a CNBC-TV18 exclusive. Infosys beats estimates in the third quarter, revises the full-year revenue growth guidance upwards and maintains the outlook on margins. Revenue growth of over 2% is higher than TCS for the third straight quarter. Shares of Paytm's parent tumble in trade after 3% stake is sold in the open market. Sources say Alibaba's affiliate company Ant Financial is the likely seller of shares worth over 1,100 crore rupees. Crude oil prices remain on the boil, hitting one-week highs on the back of the China reopening and concerns about the supply of Russian oil. Top brokerages including Bank of America, Goldman Sachs, Morgan Stanley expect Brent prices to touch the $100 to $110 a barrel mark. All right, those are the top headlines that we are tracking for you. But as always, let's begin with the day's market action. Market ended the day lower, but it was sharply off intraday lows as well. Nifty and Sensex closed 0.25% in the red. The Nifty is now at 17,858. The broader markets underperformed the benchmarks. Prashant Nair is here with the details. Prashant.
Well, the market sold off quite aggressively, only to recover towards the end. We ended down about 30 points. It was volatile, not very wide in range. But it looked tricky at one point. That low that we've been talking about, the December swing low, that was broken briefly. We went below it by about 15 points or so, and then there was a sharp bounce back. I'll come to that in a bit. Banks, again, I mean, they were selling. Private bank index coming under a fair bit of selling pressure. Large caps which lost, Divi's Laboratories stood out. BPCL was under pressure. Reliance Industries, RIL, we pointed out yesterday as well. It's been weak for a while. And that is a problem because it's got about 11-12% weight on the index. Tata Motors was weak and there was Axis Bank which lost today. SBI Life, Ultratech and HCL Tech were some of the stocks which did well. Of course, earnings season is in full flow and some of these stocks will respond to earnings. Broader market breadth was 1:1, little bit in favor of declines, almost 1:1 then. So losses coming through in names like Paytm, where there were large block deals. Nalco lost today. Divi's Laboratories, Gland, Granules, Stovecraft were some of the stocks which came under pressure. Gainers in the form of Navin Fluorine. Rate gain is up 20% this week, including today 6%. Cyient reported in the last hour. Stock was up 5%. BKG and a few others doing quite well. The market for now has held on to that 17,774 level, although with a bit of a brief break. So that still remains the level to watch on the downside. But I think what the decider is going to be the inflation numbers out of the US later tonight, which I think will set the course for risk assets when we come back tomorrow morning. Back to you.
All right, Prashant, thank you so much for that. Moving on to some market opinion now. Market experts tell CNBC-TV18 that equities is not the most preferred asset class today and valuations remain quite punchy relative to other markets. But all repose faith in the India growth story. Listen in.
In terms of the valuations, look, I mean, India is the most expensive market in the region, right? It's still trading at 22 times forward earnings, which is higher than the rest of the markets in Asia. India was trading at almost twice the valuations for the overall Asian region at almost 22 times. The region was at 11 times. So we had a premium of about 100%. That has come down to around 65%. The long-term average is around 30. So there is still some room for further contraction.
The reality is valuation upside is very, very theoretical because I think everything is costly. Everything is costly. So to put that into picture, I guess the largest sector financials is the one which is a consensus overweight. So we decided to hug with a consensus overweight there, and we have actually increased weights of financials. We also have a overweight of healthcare, which is a overweight which is continuing from last year. So last year it didn't do well for us, but then we think it's again a situation where things are bottoming out.
Over time, of course, private banks have shown the ability to increase market share relative to, let's say, public sector banks or NBFCs. But I think the key really in the longer run is to have a good liability and asset franchise together. And that's what's been supporting private banks. But all will exist because NBFCs have their own skill. And especially as you go down the population curve in income levels into tier 2, tier 3 and beyond, we call it India 2, India 3. The role of NBFCs is pretty important because they're able to reach out.
All right, that's some expert opinion coming in. Moving on to the second headline now, and it's a CNBC-TV18 exclusive. The merger of multiplex chains PVR and Inox has been approved by NCLT in Mumbai. Sources say that a written order is likely in the next 15 to 20 days. Both stocks closed with gains of 3% each. Nimesh Shah is here with the exclusive details. Nimesh, what are you picking up?
In a CNBC-TV18 exclusive, what we understand from sources that the Mumbai NCLT has today finally approved the merger between Inox and PVR. In an oral order, the judge has pronounced the merger. Now, the written order is expected in the next 15 to 20 days. Now, we all know the merger ratio. It's basically 3 shares of PVR for 10 shares of Inox. After the written order is through, over the next couple of months, the merged entity will emerge. Now, what will the merged entity look like? The merged entity will have a network of more than 1,600 screens pan-India, and the merged entity is aiming to add at least 200 screens every year. Now, both the promoters will have 2 board seats in the merged entity. The Inox promoter will have a slightly higher stake of 16.67% in the merged entity, whereas the PVR promoters will own close to 10.6% stake in the merged entity. Now, the merged entity will have a market share of 40% across the 7 big cities. So that's the big conglomerate which will emerge after the merger. But in the news, today the Mumbai NCLT has approved the final merger between Inox and PVR.
Nimesh, thank you so much for joining us with all those details. Now to the third headline of the day. Infosys reported a beat on its top line in the third quarter. Margins were a slight miss. However, the biggest takeaway is that the company has revised its FY23 revenue growth guidance higher from 15 to 16% to 16 and a 16.5% mark. Reema Tendulkar is here with the details. Reema, take us through the key highlights from the IT majors third quarter.
Thanks so much for that. It's a very strong showing from Infosys this time. A revenue beat, a guidance upgrade, very strong deal wins. But there is a bit of a margin miss. But on the whole, it's a good quarter. So let's tell you about the numbers. Revenue growth has come in ahead of expectations, 2.2% in dollar terms. Constant currency revenue growth has come in at 2.4%. EBIT margins are flat at 21.5%, and this is despite 40 basis points benefit due to the rupee depreciation. In fact, both Infy and TCS have reported a revenue beat and a margin miss. But if I compare the revenue performance, Infosys growth rates are stronger than that of TCS. The big positive was the fact that revenue guidance was revised higher. It now stands at 16 to 16.5% constant currency revenue growth for this year, which compares with the 15 to 16% revenue growth that they'd earlier guided for. In fact, every single quarter of this year, Infosys has gone ahead and upped the guidance. The deal wins are also very strong. Deal wins, the highest in the last 8 quarters, have come in at $3.3 billion.
But Reema, that's not it. Even HCL Tech reported its earnings for the third quarter. How were they? Tell us the analysis.
HCL Tech has reported a revenue and a margin beat. Now, this is the third consecutive IT company which has reported a revenue beat this time. Both Infy and TCS had reported a strong top line, and now it's HCL Tech. HCL Tech's dollar revenue growth has come in at 5.3%, much ahead of expectations of 3.5%. Constant currency revenue growth of 5% is also looking solid, 13.1% on a year-on-year basis. Margins is where HCL Tech has beaten its peers in terms of a surprise. Now remember, both Infy and TCS margins missed the mark. But for HCL Tech, margins have expanded by 165 basis points to come in at 19.6%, and this is much ahead of consensus expectations. A quick word on the full year guidance. FY23 revenue guidance is now seen between 13.5% to 14%. The earlier guidance was 13.5% to 14.5%. But in December, the company said that growth rates will be at the lower end of their guided band. So that's what they've done. They've tweaked the guidance and they've said that it'll be 13.5 to 14%. Services revenue growth between 16 to 16.5%, and EBIT margin guidance band too has been narrowed towards the lower end of the earlier band, and now it stands at 18 to 18.5%. The deal wins are steady on a quarter-on-quarter basis, coming in at $2.35 billion. It's up 10% year-on-year. So it's a strong showing from HCL Tech, a beat in revenues and margins. FY23 guidance has been tweaked, but that's in line with market expectations and the company's own updated performance in December.
Welcome back. You're still with us on Markets Today. Let's go to the rest of the headlines that we are tracking for you. To the third headline now, shares of Paytm's parent tumbled in trade today after 3% stake was sold in the open market. Sources say Alibaba's affiliate company Ant Financial is the likely seller of shares worth over 1,100 crore rupees. Nimesh is here with those details. Nimesh?
As you rightly pointed out, there is a large block, nearly 3% equity changing hands and at a deep discount, and hence that's the reason why the stock is under pressure as well. But what I understand from sources, most likely Ant Financial, which is a large shareholder in Paytm, they were the likely sellers in today's block deal. So, if you look at the shareholding pattern of Paytm, it's largely owned by institutions. Ant Financial owns 24%, little over almost 25%. So 24.8% stake is what Ant Financial holds in Paytm, and they are the likely sellers in today's block. I still don't have a color on who are the large buyers, but looks like it's going to be institutions, both domestic and both domestic and FIs would have participated on the buy side. But what I understand is on the sell side, Ant Financial was a likely seller in today's block deal. As I said, it's largely institutional owned. If you look at the top holders of Paytm, Alibaba still owns 6% stake. They sold a large chunk a couple of months back. Even their lockup, I believe, is going to open up in the next few weeks from now. So Alibaba owns a little over 6%. There is Self Partners, which is a large private equity. They own close to 15%, and Ant Financial, which is a likely seller in today's block, they own close to 25%. So it's largely owned by institutions, but looks like in today's block, the seller was Ant Financial.
All right, Nimesh, thank you so much for joining us with all those important details. To the fifth headline now, crude oil prices, they remain on the boil, rising 3% to a one-week high. This has hopes for an improved global economic outlook and concern about the impact of sanctions on Russian crude output outweighed a massive surprise build in US crude stocks. Brokerages predict that further reopening in China could push prices to $110 a barrel. Manisha Gupta is here with more on this. Manisha.
Well, it's a one-week highs on the crude oil prices, holding around $83 a barrel, and this is far away from the kind of low that we saw in the last week of December at $77 per barrel. So it has been a good comeback for the crude oil prices. Support comes in from the China reopening its economy, also concerns about the sanctions on Russia and impact of that on production, and then it has to be about the weak US dollar index trading at around 7-month lows. That also has been supportive for many of these dollar-denominated commodities. Well, the crude oil prices traded 2022 as a second straight year of gains. We did see Brent gain up by 11% in the previous year, and this year as well we have come off the kind of lows. Going forward, there's an interesting report from banks and brokerages expecting higher crude oil prices, especially from the third quarter of 2023. Citi believes, and they have the most conservative of view, that $75 per barrel is where we could see 2023 ending. But EIA, Fitch and Wood Mackenzie are looking at an average of $95 to $96 per barrel going forward. And then three digits are back with Bank of America, Goldman Sachs, Morgan Stanley, all saying that $100 to $110 per barrel on the higher side is where the crude prices are headed in the second half of this year. The most bullish of the views comes in from Pierre Anduran, who says that the crude oil prices could exceed $140 per barrel as well if the full Asian demand comes back into the market.
All right, crude oil prices on the rise. Manisha, thank you for that. Moving on to the stocks in news today, Nalco slipped 3% after Kotak downgraded the stock to a sell from reduce. Nigel is here with the details of that note. Nigel?
Well, that's right. Nalco is under some pressure because Kotak has gone ahead and downgraded the stock to sell, from reduce earlier. They have fair value, though, is unchanged at around 70 rupees. They believe that the risk reward is not favorable as of now. Three broad reasons is what they've mentioned. First up, they believe that earnings will be range bound for the next few years, and the reasons they have cited is that aluminium prices, they don't expect it to run away, and there continues to be some cost pressures on the alumina side. Point number two, the free cash flow, well, they don't expect it to turn positive for the next few years because most of the money that they'll be making will be used for the alumina refinery expansion, which is return dilutive as well. So that's point number two. And point number three, valuation wise, well, the stock is trading at around 6.5 to around 7 times EV per EBITDA, which we know for a metal stock is not very cheap. So put all this together, the stock is reacting to this note and it's down 3.5%. Back to you guys.
All right, that's Nalco. Nigel, thank you for those details. Sticking with the stocks in news today, LNT that gained 2% in trade today. This is after JP Morgan raised target price on the stock. They have an overweight rating on LNT and they say that 2023 will be another year of positive returns with core upside for LNT's business as well. So the core PE multiple, it should remain cemented, and that is because results could meet FY23 guidance after 3 years. So they are expecting FY23 numbers to be in line what the company had guided for. They expect robust mid-teens growth in FY24 for the company, and they see potential in both the markets, India and West Asia as well for the company. They see continued strength in execution for the company, and large book-to-bill and stable working capital is something that is working for the company, and it will continue to see growth in the coming months as well. So that's about L&T. The stock closed higher. But with that, we'll move on. Here's a CNBC-TV18 exclusive. Axis Bank's likely to revise its pact with Max Life Insurance, and the bank is likely to propose a price of 85 rupees per share for the additional 7% stake in Max Life. Yash Jain is joining us with those details. Yash, what are your sources telling you?
Well, that's correct. I mean, since the start of the week, when Axis Bank informed the exchanges that they will be entering a revised agreement with Max Financial Services, which will be to acquire the balance 7% stake in Max Life Insurance, there have been various reports which essentially tried to put an estimate in terms of what the revised pricing could be. What we've been given to understand from our sources is that Axis Bank is likely to propose a price of 85 rupees per share when it comes to acquisition of about 13.4 crore shares. That is 7% stake in Max Life Insurance. As far as this revised pricing is concerned, since it's much higher than the earlier 13%, which was 32 rupees a share, the size of the transaction also increases. So as per 85 rupees per share, the size of the transaction straight away increases to about 1,139 crore rupees from the earlier 429 crore rupees, which means that Axis Bank will have to pay an additional amount of about 710 crore rupees if the transaction is indeed executed at 85 rupees a share. But do remember that this will just be a proposal or a request from Axis Bank, that this is what we think the fair market value is, that is 85 rupees a share. The final decision on whether to accept this pricing or decline it would be in the hands of the regulator, that is the IRDAI.
Okay, Yash, thank you so much for bringing us those important details. We'll keep coming back to you for more updates on this one. Moving on to the pharma space now, Divi's Labs and Gland Pharma saw steep cuts today after reporting a drop in exports for the third quarter. Ekta Batra is here with all those details. Ekta?
Well, yes, I'll start with Gland Pharma, where the export data is indicative of a weak amount of exports by the company, which could possibly reflect in their quarterly numbers, which is in Q3. So it is down 14% on a sequential basis in terms of the export data, and down around 12% or close to that level for Gland on a year-on-year basis. So they've generated around 654 odd crores in terms of total export sales this time, which is a decline both year-on-year as well as Q-on-Q. Now, drug-wise, the largest decline is in fact seen in a drug which is used to reduce blood clots, which is basically low molecule weight heparin, as well as enoxaparin, which is declined Q-on-Q. It's down over 55% on a sequential basis in terms of export sales for this particular drug. On a year-on-year basis, an antifungal drug has seen the sharpest decline, which has probably impacted sales the most. It's down over 70% on a year-on-year basis. Now, coming to Divi's, the export data ex of molnupiravir is strong. So molnupiravir has come down quite significantly, which is basically the COVID-19 drug by Merck. They generated revenue of as little as around 20 odd crores as per the data in this quarter, which compares to around 292 crores in Q2 of FY23 and over 970 crores same time last year. However, ex of that, the ex of molnupiravir, Divi's export sales are up around 14% on a sequential basis and 30% on a year-on-year basis. Now, we don't know exactly what the correlation would be in terms of this export data, in terms of the quarterly sales that the companies do report, but largely, if you just look at the data, it is definitely a mixed picture at this point.
Take that point, Ekta. Thank you so much for joining us with those details. And with that, it's a wrap in this edition of Markets Today. Thank you for watching.